it is. All right. Well, one thing that I'm excited to do today is to have Lauren Patterson talk to us a little bit about 203 203K loans. I did my first 203K loans a few years ago, and I'll have Lauren explain more what it is. But we were talking here on Friday, and it opens up a whole new field of clients, of sellers and buyers to the average agent. And in a nutshell, like I said, Lauren will go into it deeper, but in a nutshell, it's where you could buy a house and finance the repairs into the cost of the house using a loan that's at a decent interest rate. Um, and that's really cool because there are, we're all getting a lot of emails from wholesalers and other people that says, oh, I have this house and, it just needs, $30,000 in repair, $50,000 in repair, or whatever else. Well, that won't typically qualify for a conventional or FHA mortgage. So a 203K bridges that gap and it allows us to buy that house with our clients to finance, the repairs and put them into a nice house. So, for example, I just put a Mike. It says Mike has no audio. You're going to leave and come back on. All right, Mike. I'll keep an eye open for you here. And so, for example, I'm putting a house under contract in Cottonwood Heights at $420,000. That's a really cheap price, but it needs about $50,000 in repair, and it's probably going to be worth around 600, maybe a little bit more when it's all fixed up. And so, ordinarily, a client would not be able to touch that property because they don't have. You'd have to buy it cash or some other way. But using a 203K loan, it's possible to do that. And they can use, they could even use hard money and then I guess go over into a 203K. But Lauren Patterson's one of my favorite loan people ever. He's certainly one of the most experienced that I've ever worked with. And let me turn my time over to you there, Lauren.
Awesome. Thank you, Randall. Okay. Can everybody see that screen? Is it sharing on your end, Randall?
Yeah, I can see it. Can you guys all see it?
Okay, perfect.
Yeah. Okay.
So who's familiar with the 203K programs? Has anybody had any experience with them? Have you done them before? Okay, I see a couple no's, a couple yeses. Okay. So what I'm going to do today, some of the details behind this are a little bit boring. This is a slide deck that I have that's about 28 pages. I'll spare you all 28 pages and we'll sort of hit on the highlights and the wave tops of this one. After we're done, if anybody has any additional questions on them, please feel free to reach out to me with these. The 203K program, they're not as popular out west as they are back east, okay? Back east because they are very limited on where they can build new homes because of densities. Then the 203K and the rehabilitation loans are much more popular than you see out west because many times people here choose not to rehab a loan. They choose to just go find a builder that's got new inventory and away they go. For some people though who want to be in a specific area, these can work very, very well. Okay, so going on here, there's basically there's really two types of 203K loans. There's what we call a 203K standard and a 203K limited. Now, Randall, are you familiar with the difference between the standard and the limited?
Isn't one of them like a kind of a streamlined deal? It's like $35,000 cap or something like that.
Yep, exactly. Okay, so the limited is really for, think of it as a buff and polish on a house. You're doing strictly cosmetic work, replace carpet, replace paint, countertops, some appliances, some things like that. It's one where you go into a house and you say, oh, look, I love the location, I like the floor plan, but this is a little dated and I think it's going to take about 35 grand to go fix this up and get it the way that I would like. So that's where the limited comes in. The standard 203K, that's like taking out a construction loan. Okay, a standard 203K, this is really a rehab loan where you can go in and do structural work. You can take out walls, you can add a second story, you can add to the property. This is really a true construction loan. Now, interest rates on the 203Ks, we'll get that out of the way because everybody says, well, what are the rates on those? They run about 2 percentage points higher than what a standard FHA loan will be. Okay. So right now, your standard FHA is running in the high fives if you're priced aggressively on them. So figure this is going to be in the mid sevens. Okay. One thing that people do with the 203K loans, though, is these loans typically and traditionally don't live much past 6 or 7 months. Okay. Clients come in, they take this out, and because they're paying 200 basis points above market, they'll use this as the construction loan. And then when the repairs are done, they'll go back in and refinance it either onto another FHA loan or onto a conventional loan if they have gained enough equity to be able to drop mortgage insurance. Okay. So here's the general parameters on a 203K. Your minimum credit score for the 3.5% down minimum payment is going to be 580. Okay, and that's now different investors out there may have higher thresholds on that. A lot of lenders will put what we call overlays to it. But from HUD and with investors that we use, you can do those with a 580 credit score and still meet the minimum 3.5% down payment. As soon as you go below 580 on your minimum credit score, and yes, there are lenders who will do these below 580, then you can actually, your down payment just increases to 10%, much like a traditional FHA loan. Okay. Again, just like your standard FHA loan, you can do them with AUS and approve eligible or accept, whether it's a DU run or a Fannie or a Freddie Mac run. If it's a refer with caution, then it drops down to a manual underwrite, and those are possible on these as well. Okay, here, parameters on these, good for purchase, rate term, 30-year fixed is the only term that you can have. Your loan to value on a purchase is going to be 96.5%, just like a standard FHA. But if you're doing these as a rate term refinance, because you can do 203Ks as refinance loans as well, then as a rate term refinance, you jump up to a loan to value of 97.75. They're good for single family 1 to 4s, manufactured, single wide, double wide, and et cetera, condos, approved condos, and PUDs. Finding these on single wides, that's a little bit tough because there's not a lot of investors out there who like to do FHA loans on single wides. But if you've got double wides, then those happen all day long. Okay. On a double wide, you're traditionally going to see it on the Streamline program, not the full rehab, because you're really not going to be moving a lot of walls and doing structural work on a double wide. Okay. The big thing that people get into when it comes to these loans are what's eligible and what's not eligible. Depending on whether you're doing a limited or a full, then the repairs that are eligible become very, very different. Okay. Again, think about on your limited, it's buff and polish, cosmetic beautification stuff. So what you're doing is eliminating health and safety hazards, for example, connecting public water, eliminating obsolescence. So that dated house, for example, would be one that works. Installing or repairing fences, things like that. Again, think of it in terms of cosmetic stuff. Okay. If you go onto it, you can also use it to repair a swimming pool. Okay. Now, if we go into an eligible, so repairs that you can't do, okay, you can't take more than 3 months to complete this. You can't go in and do structural modifications. And if you have mold in the property, which we have a lot of questions on that people will come in, you automatically kick over to a full 203K, not a limited. Okay. Then if we go down a little bit farther, let's go into 203K ineligible improvements again, and the list keeps going. Sorry, I'm getting lost on my slides here. Standard, here we go. So you can convert a single family structure to a 2-family structure, believe it or not. So if you can legally go in and take a single family and turn it into a duplex, you can use the 203K standard to do that, okay, which is very cool. You can replace plumbing, heating, AC, electrical, okay? You can make changes for aesthetic appeal. You can repair or add roofs, gutters, downspouts. You can do energy efficient improvements on it. There's basically not much you can't do. The things that you cannot do on the full 203K would be luxury items. Okay, so you can't put a swimming pool or a hot tub in, but you can replace or repair a swimming pool or a hot tub. Okay, you can't put in tennis courts, weird. Okay, you can't put in satellite dishes, I know, but those are all the things there that you can do on a full 203K home improvement loan. Okay, your time period for renovation, you've got to start the work within 30 days. It has to be completed within 3 months for a limited or 6 months for a standard. Now on the limited, because it's only $36,000, the documentation that's needed is much more simplified than the standard 203K. On a standard 203K, you're going to bring in a contractor, you're going to have bids. Many times you're going to have engineering reports. You're going to have a cost breakdown. You're also going to have to bring in an FHA 203 consultant, which is a person that specializes in these, who monitors the process on these. The contractor will get draws throughout the period, okay? And you cannot do any of the work as the homeowner on that. It all has to be done by the general contractor or his subs. Okay, this goes through just what happens with the subs and the contractors. It says who can do it, who can't do it. I won't bore you folks with the details because it's really not relevant to what we're doing at this point. Okay, your contractors, what they have to be, they can't have an identity of interest transaction. They've got to provide specific forms to HUD when they do this. Okay, here's where your HUD consultant comes in. You can find a link for these guys if you need one. Their fees range anywhere between $400 and $1,000, depending on the work
Love
that's
you.
being done. Okay.
Bye-bye.
Oh, oh, thank you. Okay, so your consultants are there again. They're there basically as the GC of the GCs. Okay, they're there to make sure that the wagons are still headed generally west and that it does stay within the timelines and the constraints that you have on these. Okay, here's a schedule just so you guys are aware and you can kind of see what's going on with what the consultant can charge for total repairs. Okay, so you can see consultants, it's not a money-making business to be a consultant. This is really somebody who's doing this as a service because it's not something where they get rich doing one 203K loan for somebody who's out there. Okay, you've got your additional charges, you do have draws, you do have inspections. So think of this in terms of a construction loan. One of the things that people will say many times is, okay, I'm paying 2 points, two and a little bit above what a 30-year fixed rate FHA loan is. That's expensive, Lauren. Why am I doing that? If you put this into the constraints or in comparison to a regular remodel or a construction loan, okay, if you go to a bank and try to get a construction loan or a remodel loan, you're not going to get one at 96.5%. You're not going to be able to put just 3.5% down and get a renovation or a construction loan through traditional construction financing. You're also not going to have the streamlined process that's out there. You're not going to use them for purchases. You could use them for refinances. So this really is a great way for somebody who doesn't have the $35,000 or $100,000 in cash that they need to go do repairs to come and do the repairs on the property and get it exactly the way that they want to see it so they can move into it.
There's one
Okay.
thing too, if I can mention that, Lauren,
Yeah.
is this a temporary loan?
Mm-hmm.
I mean, like most of what I do. So I think we sold 3 flips last month. So I've got probably 7, maybe 8, in play right now. I'm paying 12% on those. That's
Right.
normal for a, construction, short term, deal. And the one thing that often happens when you do these remodels, like when I did mine, I increased the value of the property by 30%.
Mm-hmm.
And so I was able to do a rate and term refi. So yes, the interest rate was 2% higher, right, than normal rates would be on conventional FHA. But by the time I had finished my project, the house was worth 30% more. So I had no primary mortgage insurance on it.
Yep.
And I didn't have to come in with money. I
Right.
did, like a rate and term refi on it. And so I think that, that's where it seems to be really powerful to me is a lot of times you can increase the value enough that you're cutting out the primary mortgage insurance completely and able to do a simple, rate and term refinance. So you're not bringing anything, any more money to the table.
Exactly. It really is. And what it also does is it opens up a listing or a property that you have to an even larger pool of buyers. Because how many times does somebody come into a property? Again, cash is a barrier for a lot of people. Okay. Most people, they can cover a down payment on a property, but when you ask them to go and put an extra $40,000 into one, or if you're doing a full remodel on a full 203K, 100, 150, $200,000, the percentage of people out there that have access to that kind of cash, unless they're going and doing hard money, which is 2% upfront and 12% interest,
Yeah.
They don't have it. So this is a really great way. It can also be another way to market the property for agents. What it also does is it puts you in contact with contractors, subcontractors, engineers, designers, which is increasing your sphere of influence, which is also giving you a greater pool of potential referral sources as well. So it really is a great program. It's one that I will say truly does get underutilized, usually because most people are not aware of it. Okay. But what you can also do with it is when you go in, it's if the property is uninhabitable. So let's say that you go in. I talked with somebody last week who the client was looking at a property. They were going to bid for below market for it, but it had some roof issues. It also had some dated issues in the house, but most importantly, it had mold in the house. The property is not habitable. Okay. On these, you can actually finance into it mortgage payments for up to the first 6 months if you're doing a full 203K. So it's really kind of cool that so somebody can go buy this property in a place that they want to live, in an area that they want to be, and go make the property exactly the way they want to. And they get to purchase it at, when they do the appraisals on these, they also do it at the after repair value or the ARV value, as Randall is so familiar with. And that way, it's not just what they're doing now. Now, sometimes they will call for an as-is appraisal on this. And the as-is appraisal is simply to say that the value of the property today is at the sales price or what you're offering to buy it at. So for example, on that one, the list price I think was 340. They were offering 290, as I recall. An as-is appraisal would mean that that property would have to come in at 290 if the as-is was called for. Okay. But when they do these, they're looking at what's being done to the property. And by doing those repairs and doing those updates, what will the value of the property be after you're done? And that's what this loan is based on. Okay. Any questions so far?
No.
Okay, perfect. All righty. Total cost of repairs, they do build a contingency into it, and it's anywhere from 10 to 20%. The consultant will recommend that based on what's there. And then they can also, the contractor on a full 203K does get up to 5 draws. They do charge 350 typically to do those, process those draws. And you can, as I said, put up to 6 months mortgage payments financed in if you're uninhabitable during the rehab. They do title updates as well. So there are some extra costs and fees that go with these just because they have to be updated as they go through the process. Again, remember, this is like having a full construction loan out there. Okay, but you actually have taken the property down with just 3.5%.
So that's interesting that you said that it had mentioned that they could finance up to 6 months of the mortgage payment. So
Yeah.
basically, it's going to cover everything. So you're coming in. Let me just run this by and make sure that I'm understanding it right. You're coming in with 3.5%, same as you would for FHA or conventional loan,
Mm-hmm.
and all the repairs are going in, and you're not having to make any payments, at that time because their mortgage payments are coming out of the loan itself.
Provided that your after repair value would support that.
Right.
Okay, so if my ARV was 340, but if I throw 6 months payments on there, if I took it up to 360, then
Yeah.
I couldn't do that. Okay, but what we've typically found is that they are able to do this, Randall, provided that the acquisition price is right, and then they can go and do it. So the nice thing about it is that you're not, unlike a property that you purchase through traditional means where you take it down, now you go to the bank and get a construction loan or a remodel loan, or you fund it yourself. You're making payments on that house even though you're not living there.
Yeah.
Okay, so you're having to cover the cost of the payments plus whatever you're putting into the property, which is one of the biggest barriers that people have, okay, to being able to take a property and make it exactly the way that they want to see it. Okay, here just right here talks a little bit about your payment reserves and what you can do with the standard. I wouldn't even worry about this section of it because this really just applies to what we do on the financing side of it. Okay, here is contingency reserves. It gives you an idea of what you need if you're greater than 30 years on the age of the property or if you're less than 30 years. Again, borrower also, this is important, they can't provide their own funds to establish those contingency reserves. That has to be included in the financing, okay, of the property, which is the total loan amount that they do. Okay, your minimum mortgage worksheet, again, I'm not going to bore you with this because these are just financial calculations. This is a presentation that I've done for people that are in finance that wanted to know more about them, and some seasoned 203K agents who said, I want to really understand this more because there's been some curveballs to them. Okay. This one, your rehabilitation mortgage, this is your minimum or your matrix. You can see it's $35,000 total renovation costs. Structural changes, as we talked about, you cannot do those. Landscaping, hardscaping, you can't do those. This is one to keep handy because if you're talking to a client, you want to be able to say, here's what we can do on this one, here's what we can't do on this one, or as you talk to them about options. Again, if you're looking for a niche, if you're looking to add some extra tools to your toolbox, learn 203K programs. Very, very, very few agents know about the 203K. They've heard of them, but they truly don't understand how they work and the mechanics behind them. And it will give you an opportunity to pick up and market for some additional business. Okay, your draws, you get 2 draws. The initial draw, the contractor on the streamline can actually get 50% of his initial draw, or of his what they think the total balance is going to be at the onset to start it, and you've got 90 days to complete it. Okay, your
It said
standard
it said
03K,
two, sorry, Lauren, it said 2 initial draws and a final. So that's actually 3 draws, right?
you're right, that is 3. Yep.
Yep.
Okay. I'm sorry, it's 2. You get an initial and a final. So you get one at the
Okay.
beginning, one at the end.
Okay. Okay. Okay.
Okay. Here's your standard 203K, and this talks about all the things that you can do on it. Okay. Structural changes, yes. The minimum on this one is going to be $5,000. So if it's below 5,000, you kick back over to the limited. If it's over $5,000, it goes onto the standard. And there's no maximum on the cost of your repairs, provided you don't exceed the county loan limit for the FHA program. Okay, this one, the 203K consultant is required. Mortgage payments can be financed. This one, you get a total of 5 draws on this one, Randall, okay, that you can use. So the other one was 2, beginning and end. This one, you get a total of 5 throughout it, okay? On this one, the contractor doesn't get the initial draw like they did on the limited, but they do get up to 180 days to complete this one. Okay. This is the little FAQ. What happens if the as-is value comes in under the contract sales price? If that happens, then the home buyer has to come in with cash. So if the contract sales price was, again, that 290 number, they required an as-is, and it came in at 280, they're going to have to bring in the additional money. So what HUD wants to make sure of is that the price that you're paying for the property today before the repairs happen is actually at market value. Okay. After that, the loan is based on what's the value of this property after all of the repairs are done. Okay. Can you use it for roof repair or replacement? Yes, you can. Again, that goes to a standard 203K. Okay, let's see. That slide got duplicated. I apologize about that. There we go. Okay, can you replace a septic? Yes, you can use it for septic. Your permit fees would be included in the bid that the contractor gives you. And there's a whole form, and there's specific forms that the contractors do use when they submit their bids on this. And that cost breakdown in those bids are also submitted with the appraisal order. Okay, because the appraiser has to be able to see the scope of the work, and that's how they're able to determine what that as is or ARV value is going to be. Okay. And then the last question is, how do you think you guys can use, or how do you think an agent can use this to increase your business and your sphere of influence? And there's a 30,000-foot flyby, Randall, of both the 203K standard and the 203K limited.
Thank you. Yeah, that is, I mean, hold on a second. It looks like I've got some I'm trying to see who somebody send me a message here, but I'll put these slides out later. Okay. So let me ask a question. Maybe let me see if we can stop sharing so we can see the
Yeah, let me stop the share.
and there we go.
There we go.
There. That's better. So if I guess my question would be we want to make it easy, right? Everybody loves the easy button. So
Yes.
how easy is this one? So they come to you. How long does it take to get this done? 30 days,
You're
45
gonna
days,
that
3 weeks?
some people will say 45 to 60. Inside 30 days is going to be pushing it. That's going to be a little aggressive. 60 days is going to be taking a little bit long. The biggest delay comes into people gathering cost breakdowns, bids, and deciding, as you know, because you've remodeled and flipped a number of homes, deciding on what they want to do. Okay.
Sure.
And especially when you start getting homeowners involved in that, where this is their dream home or the home that they're going to live in, it can take a little bit longer. It's not like a seasoned investor who says, okay, I've got the property. You've already got an idea when you're going to take it down on what you're going to do, and you can go through it. I mean, a good flipper, he knows literally within 72 hours what he's going to do with that property and what the approximate costs are going to be. Okay. If you can get it that dialed in, then you're going to be to the closer to the 30-day mark. Okay. 35, maybe 40. But again, if you're back and forth, if you haven't selected contractors, if you're interviewing contractors, again, and depending on the scope of that work, then plan 45 to 60.
Right. So, I mean, a lot of people aren't going to want to go 60, so I'd probably plan on a 45 day, just tell
Yeah.
I mean, you just tell your clients that, hey, we're going to have to get on this right away. So you've got the consultant there. I mean, who's the consultant? Is that you? Is that somebody else? Is that
No. FHA consultants are specialized and they actually have certifications to be an FHA consultant. If you need one of these, there is a link that I can send out to everybody. I think it was actually in the presentation too, where you can go find a list of FHA certified consultants.
okay?
Okay. But it is somebody that you actually bring in who they are specialized in doing this. They have had to actually get certifications to be an FHA 203K consultant.
Now, does that required? Is the consultant required on a 203K, or is it just something nice to have?
No, on a full, it's required.
Oh, kind of full it's required. Okay.
Yeah, on the limited, it's not.
Okay. So that, I mean, basically they're going to walk, the client through everything, right?
They're there to steward the process, okay, and to make sure that everybody's coloring inside the lines, if you will. All right.
Yeah.
And again, because they deal with these all the time, sometimes they're able to give you some little reminders or heads up on, hey, this is going to throw you out of whack. They're also the ones who are reviewing the cost breakdowns and the submissions from the contractor as well to make sure everything's there. So they really are a real value added benefit to these. Yes, there's a cost to them, but if you didn't have one of those, then this process would drag out beyond 90 days and some of them would never close.
Sure. So, contractors getting paid, like when I did it initially, it took a while to get the contractors paid. How quick do they get the draws?
They're fairly timely. They really are. They don't drag their feet. Okay. Again, so the escrow account with the investor is set up and the money's in there. And that's why they want that third party who's the 203K consultant, right? Who's been approved by HUD to go in and monitor this. So then they say, here you go. So it does become more timely. It's not like you're submitting it just to somebody who's, working out of their basement per se and saying, I'll get to it when I get to it, because the success of the program depends on everybody being timely on this.
Yeah. Yeah. No, you want it to be a well-oiled machine.
Yeah.
You don't have it done.
I mean, and some contractors, they don't, if you ask them if they get their check in a week, did you get it fast enough? They'll say, no, I should have got it within 48 hours, right? What took so long?
Yeah.
But it's one of those things. And others say, just as long as I get it in a couple months, I'm good. But no, they are quick with them because they know that if they start delaying that process, okay, and if they start dragging their feet just because, then the whole system doesn't work well. And then it starts getting a bad rap.
Right. Okay. It sounds like it's come a long ways.
It really has. I mean, 203Ks have been around for a long, long time. This is not a new invention. But it's much like, think of the old when reverse or HECM mortgages came out, okay? How those started out one way and then they became something different and they've been improved immensely. But there are still, when you talk to people, there's a lot of misnomer about that reverse mortgage that goes back to the earliest vintages of them, where they got a really bad rap and where people really didn't like them and they weren't designed as well as they are now. It's the same thing with the 203K programs.
Okay. So let me recap. So basically, there's two types of 203Ks. There's the streamlined, or the limited version, which is 35,000 up to $35,000 non-structural, but you can use it for a roof.
If you need to put a roof on it, if you're doing shingles, then
Yeah.
you could. Okay. Again, this is cosmetic things. So if you think of that, anything structural or where you're really digging into the meat of it, then it becomes the full 203K.
Okay.
Anything that's think of it in terms of what's on the surface. Okay.
Okay.
And as long as I'm doing surface work, if you will, then I can go down the streamline path. You don't need engineering reports. You don't need subcontractor construction breakdowns. They become much more simplified. Okay.
Yeah.
Those ones go much quicker as well.
Which is kind of nice because I mean, what about kitchen cabinets? I'm guessing that's that's
Those
something
work.
as
Yep.
well. Yeah. And
Mm-hmm.
so that that could make it quite nice. And the streamlined version, how long does it take that one? I'm sure it's not 45 days to run
No,
through.
that one you can, again, if everybody's on it, you can get that thing done closer to 30 days. Okay,
Okay.
but you can also, like a lot of times you want to update a bathroom, right? You want to put in new counters, new cabinets, you want to redo the tub surround. Again, you want to update it and bring it current. Okay,
Yeah.
you need new carpeting, you need new flooring, okay, that's where that 203K streamline comes in, or the limited really, because we call it a streamline, but it's really the limited because you can actually on these, if they were to stay in place, there is a streamline refinance option as well.
Oh, okay. So talk to me a little bit about that.
So the streamline refinance option is one where if you've been current on your payments, then you can actually do a rate term refinance without having to requalify for the loan. So a standard FHA loan, if I took it out now, let's say rates were 8% on an FHA loan today, and then a year from now rates are down at 5%, but I may not be working or I may have too much debt right now, I don't have to requalify for that loan on a streamline refinance. I just have to show that I'm current on my payments, that I have never been late. Some lenders will want to see that you have income still coming in. Other lenders don't. Again, this is where guidelines between investors go from C to shining C because they put
Yeah.
overlays to them. But it's really just a credit qualifying refinance. Do you have the score and have you been making your payments on time? And then you can roll down to a lower interest rate.
Awesome. So that sounds good. I mean, that would fit a lot of people. I mean, there's a lot of things that like we all see houses. We just haven't found the house. It doesn't have the bathroom. It doesn't have the, whatever, or
Mm-hmm.
you
Yep.
know,
The
something.
other the other area where these come in and can be very beneficial for you is, let's say that you do have that house that the homeowner has had for the last 60 years. Okay. And let's just say that in this case that the homeowner's now passed and you have to go sell the house and it's not updated, it's not remodeled, condition is a little bit questionable. Typically, who are your buyers going to be on that property? Okay. A lot of flippers will come and offer on that. Okay. Or somebody that wants to move into the area or may have somebody there who's flush with cash. Okay. Then they'll consider going in there as well. If you were to market this as a 203K product, now you're not going to have to be at the whims and the mercy of that investor who comes in and is going to lowball your offer
Yeah.
because they're going to come in under market. Okay. And that's going to happen. So the 203K, if you're on the listing side, also presents you with some additional options that you may not otherwise have.
Got it. So let me ask one more question on this, the limited one. So would adding a bathroom, would that come under eliminating obsolescence, or would that be move you into a standard if you're just trying to add a bathroom?
It could be considered. Okay. It depends. How's that?
Okay. All right. So you could try it, right?
There's nothing wrong with trying, and the worst thing that we hear is no. Okay. Have had them go both ways.
Got it. Okay. So that sounds, that sounds good. So
When you think of structural, Randall, think
yeah,
more in terms of I'm adding 2 bedrooms and a bathroom, and I'm actually pouring footing foundations, and I've got to go outside my footprint.
got
Okay.
it.
Or I'm removing a load bearing wall and I'm going to open this room up. Okay. Now I'm doing true structural work. Okay. But if I'm in my basement and I've got, oh, look, I can put up some non-load bearing walls. I've got a plumbing hook up here and I'm going to put this in, then that becomes obsolescence work that I'm doing as
Okay.
opposed to doing true structural.
Okay. I like it. So yeah, no, that's good. And then the next question that I had was, so while you're going through your 203K, can you be working on a refinance? How quick can you refinance after it's complete is what I'm saying.
Depends on the loan that you're going into. Okay. If you're going back into another FHA loan, then no, you have, because FHA has a minimum waiting period, right? You've got to wait at least 6 months. You got to make 6 payments
Okay.
before you can refinance that. If you were going into a Fannie Mae Freddie Mac loan, then as soon as that was done, so let's say on day 120 or 130 or 150, then yes, you could come out of that and go back into a conventional loan if it made sense to do so.
Okay. So really
Because
quick.
conventional loans don't have seasoning on a rate term refinance.
Right. And what's the interest rate difference between conventional and FHA currently?
Oh boy. Depending on credit score, FHA is miles ahead right now. Anywhere between a half percent and 1%.
Okay. Yeah, I was going to
Yeah,
say sometimes, you
in
know,
every in every scenario that I've compared recently between FHA and conventional, the FHA loan on a monthly payment basis. I just did one on Friday for a client that's going new construction. He said, "Why don't I go conventional? Because then I don't have the upfront mortgage insurance." And I said, "That's a great question. Let's go run it." And yes, he didn't have the upfront mortgage insurance, but his monthly payment on the FHA was almost $300 less a month than his conventional loan.
yeah, yeah, I can see that happening.
And his down payment on the FHA loan was 3.5% versus conventional is a minimum 5.
So what about VA loans right now? What's the interest rates on those compared to, the others?
VA is running about the same. When I price them out, the way that we've got them set up, they're running right about the same as FHA. So
Okay.
FHA and VA are running sort of lockstep, hand in hand in terms of interest rate.
Okay. Sounds good. I've never done a VA loan because when I've needed one, it seemed like it was better to go conventional or something else. So I got somebody smiling in there. Christina.
Oh, we'll
Phone.
Chloe,
we'll get you
say hi.
we'll we'll get you a VA loan someday, Randall.
Yeah, yeah, it's awesome. Well, thanks. That's a lot of good stuff because if you've got a property that you're trying to list and it needs some work, they could, I'm guessing one of our agents here could go to you and say, hey, Lauren, we'd like to sell this. We'd like to mention, that, you can use it, for a 203K loan. And you could, walk them through, some of the specifics they might need to know on, listing or etc. Or with a buyer, you know, let's say, we had a house that had a lot of mold in it. We bought this house over in West Valley, and I think it was a plumbing break or whatnot, but there was a lot of mold, not
Mm-hmm.
a level. Um, but I got it cheap, and
Mm-hmm.
I'm just finishing it up here, but I got it really cheap, and something like that. As a buyer, I could say, okay, um, it's going to be, the after repaired value on it's going to be 600,000. We bought for three. you know,
Yeah.
hopefully, it's going to take about 100,000 to get it where we want it. Um, it sounds like that would be ideal, and
It
I make 6 payments, but by the end of that, I'm not going to have any primary mortgage insurance because I'm going to have 20% equity.
Well, and if you think about it, if you were to go, I mean, theoretically, if you go down that full 203K path on that scenario that you gave, if you financed in your 6 payments,
Yeah,
okay, then let's say that you popped out of that, and even if you had to make one or two payments
yeah,
after that, yeah, then if you were to jump back over onto the Fannie Mae Freddie Mac side of the world, drop your monthly mortgage insurance, it could be extremely attractive for people. The really big benefit to these are for the listing side, it does open up an entirely new and broader market. Okay. And it potentially opens it up so that you can list that property and take that listing, not selling it to an investor who we know is going to come in and try and get it for as low as they possibly can. Not saying unfairly, but that's the business model that you have to
sure.
have, right? Whereas if you're selling to a retail end buyer who wants to live in it, it's not the same dynamic. They're looking at it from a completely different perspective because it's not a business transaction for them. It becomes a lifestyle transaction.
No, that's a really great way to put it. Do we have any questions for Lauren on this?
Either I did a really great job or it was extremely boring and dry.
Yeah, no, I think you did a good job. Just unmute yourself if you've got a question. We're happy to answer any of those questions, but I think it's a good tool. Jose,
Yeah.
did you have a question?
Yeah, so I was actually talking
Hey,
to Hey Lauren, how you doing?
good.
I wish I would have got this 30 days ago. But so I had a house that had mold in it and it just didn't go well because they thought we could go conventional. But yeah, it's definitely well, this is a house that was what I wanted. Like well definitely the 203K would have been good if I knew about it. Um but I guess the question that I had was besides the 3.5% and like the inspection appraisal, do like the permits and the draws and paying the contractor, is that do they have to bring anything more to pay them?
No, that's part of the cost breakdown, and that's financed into the loan.
Okay, gotcha. Um, and then like because I've done like plans before and they usually take longer. Like we're talking like if they do want to do like the full 203K, um, like do they gotta get like an architect or because usually plans take a while unless they're really good. Are they do they have all that people to do that, you know?
That is something that you and the client would go source out yourself. Okay.
Okay.
But and it depends on, do you need an architect? That depends on the scope of the work that you're doing. Okay.
Yeah.
If you're putting in an entirely new roof and you're putting in a second story and then yes, you're going to want plans and specs and engineering. But if you're not doing something that extreme, then you may not. Okay. So it really does become client specific on what they want to do with the property.
Okay. And then when you recommend if someone wants to do a 203 cone because that's what they want to do, like make sure to have like contractors and you go in kind of like because if you're gonna go a house, because I was trying to do I got I went with a house that had mold and other issues as well. And I went with the I went to go get an inspection, but the inspectors was like this house smells like mold and fish and all the other things. They don't want to inspect it. So I went I went to go get a contract to get bids so I could lower the price for the buyers. Um and so I guess to what I'm trying to say is you probably recommend getting like multiple bids and just having like a vision of how you want it to be prepared, right? So it
Mhm.
goes smoothly and fast and you can have all the quotes ready and all that stuff, right?
Yes, it's like again, it really comes down to what the buyer is most comfortable with. Um, I would, if it were me, I would look at it, getting, several bids on it, more than one, but I can't say that, oh, you've got to go get three. That would be how I personally would do it. Okay. And and the first one would likely be the most difficult one to do is you decide what you want to do. Once you know exactly what you want to do, getting bids from the other two would be a very simple, straightforward process. The good news now is that a lot of your contractors and GCs aren't as busy as they were a year and a half, 2 years ago. So now you'll also find them much more willing to put the time in to do one of these as opposed to what they were doing before, where a lot of the investors and flippers were keeping most guys busy 24/7. Now everybody's got a little bit of extra bandwidth as well.
Yeah, that makes sense. And then when you want to run the numbers, kind of like when on a 203K for your client, you kind of want to look at it as a flip too, right? You want to make sure you're getting it almost at the market as is value, right? Like 70% ARV or so it can make sense, right? So we won't pay too much over it.
Yeah, I would say probably go to 80%.
Up to 80%.
I've never lost money at 80% of ARV minus repair costs. So yeah.
Okay.
Yeah, it's depending on who you're competing against. And this would be where I would point you towards Randall, because if you're competing against investors and flippers, you would want to make the offer if you because your closing's not going to be in 7 days like Randall would be if he's taking that. Well, Randall would close on it the next day. Say, here's your money. But if you were looking at going longer than that, then you want to make that offer attractive to me as a seller, right? Because if I'm going to forego my cash today, let's take that same property. I list it today at 300. The as is or the current market value today, and we'll just make up a number, is 280. And I come in as an investor and say, yeah, but I've got to put this into it, and here's what it's going to be. So I'll give you 260 or 265 for it. You want to be able to position your client so that for me as the seller, it makes sense for me to say, I'm going to forego my cash today that I'm going to get from Randall over here to wait 45 or let's say 60 days for you to come in to do this deal. Yeah, it's worth it to me to wait that long for that extra money.
Okay, that makes sense. And then another question was like my clients were pre-approved for 315. We wanted to buy it at 300 first, and then we went down to 270. Um, like after they say they wanted to make like where they wanted to put so much money into the rehab where it would be over their pre-approval 315. We can't go over that, right? That's kind of our limit, our top. Like,
Your upper end limit. So if the after repair value on that property, let's just take your example, where they were pre-approved up to their ceiling was 315. If your value after all of the improvements had been made was 360, okay, and that would be your total loan amount. If they were only approved up to 315, then they couldn't finance the 360. So they would then have to come in with cash as that differential. Whatever the maximum amount that you can get the loan approved for is going to be the ceiling, regardless of what that ARV value is, right? Because HUD's not going to loan you more money than what you're actually approved for.
okay, that makes sense. So they could only they'll be maxed out at that difference. That'll be like how much repairs they could do, you know. In that case,
Yes, that's one way to look at it. Okay. So at that point, now remember, HUD does have minimum property standards. Okay. So as long as you're still meeting that, so potentially on that one, you would then say, okay, guys, we can't do the paint that we wanted to do, and we can't replace the flooring that we wanted to do, and we can't redo the kitchen counters, and we can't redo the cabinets, but we can take care of this part of it. That's the real issue on this house, which was the roof and the mold, right? Like those were the two big ones on that one. So
yeah.
potentially you could do that. Okay. But you
Okay.
may not be able to get it all the way to the point where the client wanted to have it in terms of, okay, here's my forever house that I'm going to live in exactly the way that I want it for the next 10 years.
Okay. That answered my question. Thanks, Lauren.
Yeah, you're welcome.
All right. Well, thank you so much for your time, and we look forward to seeing some of you use this great tool, and hopefully increase your pool of buyers and sellers. I know it made me think when I talked to Lauren Friday and got an update on it and found out how much better the process has gotten over the years. So thank you, Lauren, for sharing that with us, and we all appreciate it. And have a wonderful week. Take care.
Thanks, everyone.